We need to discuss two things today. We'll be quick. One is a case where the taxpayer took SARS's decision or SARS's apportionment ruling for VAT on appeal. And the other one is a draft binding general ruling that SARS issued about what happens when your year of assessment changes, what happens to your tax returns, right? It's a long overdue note. I think most of us know what that means in practice. But it is a draft note, but we'll discuss those two things. I'm Nico, I studied some tax. For those of you who don't know me, this training is intended for my staff. For those of you joining online, just for your interest's sake. Right, let's get into this case. And I feel, honestly, like a stuck record when it comes to proof, because it's just, it's just like some people just don't get it, right? You can be the smartest person in the room with a fantastic little argument about why the VAT apportionment ruling doesn't make sense, and you can be very fine and very logical, but if you don't understand proof, you're going to get nowhere, as did the taxpayer in this case. All right, so the first is the VAT ruling judgment, and then the next is SARS's binding general ruling. Let's look at the VAT case. So the taxpayer was a registered bank and VAT vendor. It made both exempt and taxable supplies, because we know financial services are exempt most, no? And it charges a fee, right? Which is taxable. The input tax on mixed expenses had to be apportioned, and the dispute concerned the apportionment method. I seem to recall, I don't know if it's the same case or whether it's a different case, but there was a dispute about whether or not you can object to SARS's decision to issue an apportionment ruling that you don't like, right? Because when you look at section, I think it's section 17 of the VAT Act, it says if SARS refuses to issue a ruling, you can object. And the question is, yeah, they didn't refuse to issue a ruling, they refused to issue the one the bank wanted. They issued a different one. And so one of the questions was, I don't know if it was in this case or in another case, but the question was, if SARS issues a ruling contrary to the one you want, does it fall within section 1042? And the answer was yes, right? That wasn't decided in this case. Maybe it was a preliminary issue in the same dispute, but we know that you can dispute it. All right, so the dispute concerned the apportionment method. The taxpayer asked SARS to prove a transaction count method. Of course, remember, they want the highest amount of input tax. And if you just use turnover, it creates anomalies, right? So the taxpayer asked SARS to prove a transaction count method, and they wanted this method of apportionment to apply across the whole of their business. The logic was that the business generated, or the business was generated mainly from taxable fee transactions, so they charge fee for transactions. And they say that most of their business is generated by transaction fees, right, which is taxable. And so they wanted a transaction count. Say if I'm doing 6 loans, but 1,000 transactions, I want more input tax because I'm doing 1,000 transactions and only 6 loans. That's as far as I can gather what their point is, right? They said that the transaction count method reflected a better use or a more fair apportionment of the input tax, right? Right, SARS did not approve the transaction count method for the whole enterprise. They approved a dual method instead. They said there's a very turnover method for your general mixed purposes, or your mixed expenses, and transaction count for retained for certain IT infrastructure transactions, right? So they didn't give them what they wanted. They said, okay, I'll give you what you wanted in relation to one portion of your business and for another portion of your business. There's a history behind this, if I remember correctly. They had rulings before that was entirely, the business was entirely transaction count, or the apportionment method was entirely transaction count. But then it started to become more like a bank. And the trouble is there's the BASA ruling, and the BASA ruling says one thing, and when you're becoming a bank, I think SARS got a little bit jittery, it's going, and I can't make an exception for you because now your business is more transactional, you're more a bank. I think was the history, and then when they applied for the ruling again, SARS said, no, now we're doing count and very turnover. Just want to close this. All right. Now here's what's important is SARS, the taxpayer objected to SARS's refusal to issue the ruling they wanted, which was disallowed. The taxpayer then appealed, and the court had to decide whether or not SARS's decision was wrong. And here's a kicker that people forget, and I wonder sometimes if they thought this through and I don't know if it's the same people or not, but when you go to the tax court on appeal and you are appealing not an assessment, but a decision, the onus of proof is on you to prove that the decision is wrong. If you had taken this on review, you need to prove that they didn't come to a reasonable conclusion. Right? If you took it on review in terms of part, but it turns out you can't. You have to take it through the objection process, or so they argue. So they had to prove that SARS's decision not to approve the transaction count method across the entire business was in fact wrong. Right. And the issue is this, they had the guy who prepared the ruling testify. No? So they don't say who this person is. But it's typical. Oh, hang on, I must be careful now. I've worked in the tax industry for many years, across various industries, including VAT. Lots of work in VAT and VAT apportionment rulings and all sorts of corporate income tax, all sorts of divisions where I did consulting. And you always have this, I get this distinct inkling, almost as if when they say something, it's the truth, right? The logic is infallible. You might be right, my good sir or good madam, but when we deal in onus of proof, your good argument means nothing unless we can back it up with evidence, right? And so the trouble is also, is the taxpayer who prepared the ruling, not the taxpayer, the guy who prepared the ruling, if I remember the facts correctly, wasn't called as an expert witness either, right? So this person could only give factual evidence. He couldn't give expert witness evidence to say this is the correct apportionment for the business, etc., because I'm an expert in the field. But this person is obviously not an expert in the field, they're an expert in that, right? And the issue is that they just didn't bring evidence. Their logical proposition was fine. They said the taxable transaction banking generated many transactions. The turnover may overstate the exempt use in a lending business. Counting transactions may better reflect the activity of the business. The argument is not irrational. Nobody said it's irrational. Nobody said, because earlier when we said what they wanted is there's a 7,000 transactions, but maybe 6 loans for argument's sake. We all go, wow, well that does make sense. I mean, if you think about it logically, that makes sense. But the argument, unfortunately, doesn't get you across the line when you are dealing in dispute resolution. Because in dispute resolution, what the issue is? Evidence. Where's the proof? The court wanted proof that transaction volume drove input consumption. The taxpayer needed to link the share cost to transaction count. Share costs included staff, system, branches, call centers, compliance. The taxpayer did not provide the required evidential foundation for its argument. Because in the person probably who testified's view is, well, I said so. And obviously, that is, you understand, we all win, yeah, obviously. But obviously is not evidence, right? There was no empirical cost analysis, there was no resource allocation study, no auditable data linking the transaction volumes, no proper factual basis showing the transaction count was the best proxy. So it seems like they really went in with, it was just, ours is more logical, as opposed to I can prove mine is more appropriate. Right? And I think part of the reason for this is when you read the judgment, the court starts the judgment, so there was some issue about who carried the burden of proof in the case. I don't know why, right? But there was some quibble between the parties about who bore the burden of proof, because that's crucial. And I think that they might have misunderstood that they bore the burden of proving, which is why they failed in this particular case, is because eventually counsel for the taxpayer, if I remember the judgment correctly, conceded and said, okay, well, clearly we're objecting to a decision there in terms of section 102 of the TIA, you bear the burden of proving the decision is wrong. And I think maybe they built their case on a misunderstanding of who carries the burden, because in a tax case, it's different than bringing a review application, because tax law is specific and tax dispute resolution is specific. And you don't just take anybody to go and litigate in the tax court, because you might find that you don't prepare the case properly, right? Taxpayer made certain concessions. The point is the taxpayer failed because they couldn't prove their case, right? The court didn't say it could never be used, transaction count. It said that, the point is you can't tell me that transaction count is better without proving it. Taxpayer failed to prove, appeal dismissed, right? The practical failure was evidential here. I think they probably have a point, right? If I look at their logic, they probably do have a point in terms of count, and that it more accurately reflects or it might more accurately reflect the taxable use of the VAT inputs, but it is what it is. Right, the lesson for taxpayers is simply this, and I've said this 1,000 times before, if not 1,000,000 times. There's a difference between saying something and proving it. You saying something in an objection or in a dispute or in an appeal doesn't make it true, right? In fact, you should, ideally, of course it's not always possible and it's sometimes very difficult, but when you make a factual statement, you must ask yourself, what evidence am I giving in support of that factual statement? So when we look at those tables that we prepare in our objections, it sets out the documents now. You should theoretically, and what we do most now is we give that footnote. Right? That footnote is not there for us, for objections to look pretty. That footnote is a reference to the annexure and the supporting document. That footnote gives us the proof in our minds and in our preparation of our case that we've got an evidence piece for that factual statement. Right? And that's why we build the cases like that, so that when we're done with it and we look at that table of documents, I know that that table of documents corresponds to a factual statement somewhere, if there's a document. If sometimes we don't have documents, I understand that, but that's what it is, right? There's a difference between a logical conclusion and admissible evidence. There's a difference between internal business knowledge and court-proof facts, right? The objection theory must still be built with the eventual trial in mind. Common mistakes. The client says they know how the business works, and everybody understands it. The guy who prepared the VAT ruling probably did a stellar job at setting out the logical arguments and why it is more logical, but there's a difference between applying for a ruling and logical arguments and proving your case, right? If I sound like a stuck record, it's because I feel like one, right? Start with the legal proposition that must be proven and identify every factual link that you need to prove that you satisfy that legal requirement. It's the same with the stupid 10102 thing, right, which I'm exhausted about talking about. 183 days, 60 days continuous. A copy of your passport proves you were outside the country, that's all. It doesn't prove what you were doing whilst you were there. The requirement is you must be earning remuneration as an employee whilst working outside the country for that period, right? So just giving you a passport copy, and I'm not saying you guys are doing it, I'm talking to whoever is listening, right? I'm saying that you're missing the legal issues and the facts that must support satisfaction of those legal requirements, and that's what you must do. And unfortunately, when it comes to tax dispute resolution, the fakta probanda, or the facts that needs to be determined or proven, is determined by the substantive tax law. Last week when I was lecturing at UP to the honours students, I said to them, you can't be a dispute resolution specialist and not know the underlying tax law. You know, somebody who only knows the TAA is going to struggle to get the dispute across the line, because the TAA only says one or two things. Without the underlying tax act, it is pretty much useless. And so too the underlying tax act, by the way, without the TAA is equally useless. But you can't be a dispute resolution expert, because what you'll find often is people who are dispute resolution experts or claim that they are, will always, when they attack a dispute, it'll always be there's a breach of the TAA here, there's a constitutional breach here, there's this. Now, what is the merits of the case? What is the VAT issue? No, it doesn't matter. Hang on, why doesn't it matter? Why did SARS disallow the input tax? Why is it not zero rated? Why did SARS disallow the deduction? Where's the income tax and the VAT Act and the 8 schedule and all those things that determines the substance of the case? Yes, I'm not suggesting that complaining about breaches of the Constitution or complaining about breaches of the TAA is not relevant. It's very relevant. We use it all the time. But on its own, yeah, you know, it's in my experience at least, it doesn't get you very far. All right. I think we get the point. All right, let's quickly just cover this draft binding general ruling on year-end changes. For me, I think this is fairly common. In fact, I did a case that hinged on this principle that SARS discusses here, I think probably 16, 17 years ago. Right, but anyways, they've now issued a draft binding general ruling. It deals about what you do, what is your filing dates when your financial year end changes, right? We submitted comments on this, Gabby? We did, no? Last week, Friday, or the week before that. Okay. So this was open for comments until the week before last week, Friday. So we submitted some comments. But it deals with income tax, provisional tax, mineral royalties, and VAT. To be honest, I just care about the income tax and the provisional tax. For those who care about the rest, you can go and read it. Right. The starting point is the question is, for when do you file tax returns, or when is your filing date if your year of assessment changes? And SARS says, correctly so, that the starting point is the Companies Act, right? So you go and change it in terms of the Companies Act, go ask CIPC, and then the Commissioner may then approve after that. And the point they make is that year of assessment, and you can go through this at your leisure, but the point is year of assessment is defined with reference to your financial year end, right? But what is important for me is that SARS must still approve it, right, if you change it. That's important. So I think, in fact, when you look at year of assessment, you look at through, the starting point is February, right? And if you want, the default is February, right? If you want a different year end, you must ask the Commissioner to approve it. So although the Companies Act sets your financial year end, your year of assessment is still dependent on the Commissioner's approval of a change in the year or a different year in, right? And the practical issue that this note does not address, that we submitted our comments on, is okay, fine, what happens if the year of assessment, let's say I change the year, let's say it's January, and I change the year to May, right? And the Commissioner by the end of February hasn't approved the year into May, but my year end was February. Must I file my provisional tax return or not in February, or must I file it in May? Right? What the note says here, it says you must file it in May, right? Because it says your year of assessment changes if the Commissioner approves it, right? And it also says that you will then have an extended year, and that's in the slides. I'm not going to go through, I'm just going to explain the principle. So if you extend your year, you will have a year of assessment that ends for 12 months or 13 or 15 months or whatever the number is, right? I think 15 is the max, right? That the Companies Act permit, or 18, I forget. Right, then you have an extended year. If you file, if you change your year and you bring it forwards, you'll have a shorter year in that year. But the point they make is you can't file, and I know this because we've dealt with this many times, is you can't file you can't file a tax return for a year of assessment or 2 years of assessment that end in the same calendar year. The system just doesn't allow for it. It's impossible, right? So what they're saying is you must file, if they approve a shorter year, let's say your year end is August and or December, and they change it to September. Then you'll have for the year Jan to September, and then the next year will be more than 12 months, right? And you'll file that in the next year. That's the point they're making. That's effectively what they're saying, and they're saying the provisional tax follows that. So provisional tax is still 6 months in, first and last at the last day of the year. It doesn't say at the 12th month, it says at the last day of the year of assessment. So if your year of assessment changed to May, your last is May, right? If you've got a year of assessment that's less than 6 months, because you might bring it forward, then there's no first provisional tax payment. Right? Required, there's only a second. And that's all in the slides. I hate slides. I hate it. I hate slides because it makes me say things that in a sequence that I don't want to necessarily say it. Right? But you get the point. But my critical message, I think, on the, and to be fair, it is still open for comments. So we did submit comments. So it's okay, but what do we do if you haven't made a decision yet and my current year of assessment lapses? Because on their own admission in the guide, if the Commissioner hasn't approved it yet, your year of assessment is still February, in my example, right? So end of February comes. Now, what happens if you haven't approved it? Because we had a case like this for one of our large clients where they changed the year end and SARS approved it retrospectively, but by the time they approved it, I think 2 years of assessment had lapsed, right? And the taxpayer kept on filing tax returns on what was then still the correct year of assessment, because I think technically that was right. And then when the Commission approved it retrospectively, some of the returns had already been filed. So it was an administrative disaster to fix it. There was penalties in the 1 year because there was an underpayment, in the other year there was an overpayment because the way in which the years of assessment changed retrospectively. So I think that's just something that maybe we'll see it on the final version, or they'll issue an interpretation note. Maybe they want to issue a binding general ruling on that. But yeah, that's it for this session. For those of you who joined late, these sessions are recorded. They're on the Unicus Tax YouTube channel.